Good morning, good afternoon, good evening, depending where you are on the planet. And welcome to the Tuesday, the 21st of June, Bull versus Bear webinar. Excuse me. Not the best way to start the webinar. Steve Miley on the call here for Trade Day. Welcome, everyone. We're going to go through our usual regular run through here today. I'm going to repeat a little bit of the stuff that I did yesterday by looking at the week, the shape of the week, and this kind of divergence we're getting across some of the financial market asset classes, possibly signaling potential for a positive reversal in equities. We're not really getting it from the equity markets yet, but I just want to point that out. So I'll just run through it. I did do that yesterday, but given it was the Juneteenth holiday yesterday, just aware that some people may not have seen that, might not have heard that. So I'm just going to do a real fast recap on that. The week ahead, plus this kind of divergence we're seeing across markets. Then we'll take a look at the articles and reports from the major news wires. Nothing really kind of majorly new going on in markets. Really from Friday. Yesterday was a very quiet day on a technical front in the year. Markets not really moving too much, given it was the US holiday. And then we'll take a look at the chart to see where the opportunities lie there. So first of all, I just want to talk about the data for this week coming up. It's a fairly light data week, to be quite honest. I think the two focal points for markets in here are going to be the UK inflation data tomorrow. Okay, because the UK is very much been I'm not saying leading the world into inflationary pressures, because it's not it's not on the back of the UK, but certainly the inflation data seems to have been ahead of getting ahead of or has been leading really what we've seen from elsewhere. So I would say that that's going to be important to see if the UK inflation data is it's going up from last month. However, whether it's going to be below the consensus, so I think that's something that's going to be important to watch, and it could be giving us a heads up on what's going on for global data. So that's going to be one thing to watch. I know it's not going to directly impact markets that most of you guys are trading, i.e. the US equity indices, maybe the commodity markets, but it's certainly an interesting data point that I think the broader market should be looking at. And the other big sort of data set we've got coming up this week is going to be the global S&P market, used to be market S&P flash PMI data. This is the heads up data for the month of June. So it's the early data we get. So that's going to be interesting to watch that as it comes through, to see if we get any further signs of maybe slowdowns in the various parts of the global economy. And then Fed Chairman Powell is testifying. This is the biannual testimony report from the FOMC, or from the Fed, to Congress. That happens on Wednesday and Thursday. The testimony has already been released. That was out, I think, on Friday. It's certainly out over the weekend. I was looking at it over the weekend. That's going to be nothing new to hit the market, the actual testimony or the report. What's going to be more important is what he actually says in Q&A. So whether he gets probed on anything regarding inflation, whether he gets probed on anything regarding the Fed's reaction and how aggressive they may react. So that we could get something Wednesday through Thursday. So that's the big kind of two events. Probably the first day potentially more important because you're more likely to get stuff out of the way in the first session, but potentially the second session as well. So that's the event, and the data events are going to be UK inflation and the Thursday's global flash PMI. If we go and take a look at what we've actually got today, nothing of real significance here. We did have the RBA meeting minutes in here come through this morning. I haven't actually seen if there was anything significant from those. I'm just looking now offline whilst we talk, whether the Australian dollar's hardly moved. So by the looks of it, not much coming out from those minutes in here this morning, with the Australian dollar not moving. We do get Canada retail sales this afternoon. That's in just under 1 hour. US existing home sales weekly data rarely impacts markets. Mester is speaking at noon Eastern time today. Maybe keeping an eye on that, okay, to see if Mester's got anything to add to what we've seen. And we get the BOJ monetary policy meetings later tonight. Now, given that they were uber dovish back on Friday, not really expecting much from that. Maybe there's something in there that they have started to move very slightly more hawkish. I doubt it from all the statement that we saw on Friday. And they are being left behind by the other global central banks. So FOMC Mester speaking at noon. Canadian retail sales in just under an hour, probably not going to impact the markets you're trading too much, unless you are trading the FX markets and you're trading the Canadian dollar, obviously. Right, what have we got in here? Let's run through 5 things to start your day in here. Recession fears, Elon Musk, Rubini and Goldman Sachs, all highlighting potential risk of a significant slowdown in a recession in the US, even though economists estimate a less than 1 in 3 chance of this happening. Okay, so Biden is wading in the debate, saying that a contraction isn't inevitable. Following conversation with former Treasury Secretary Lawrence Summers, Musk musing mostly on the words from Musk. I mean, great. He spoke to Bloomberg, right? But I mean, nothing really in here. He spoke about cryptocurrency and Tesla's compliance supply constraints, with the biggest break on growth, but nothing in here that's going to particularly significantly impact markets in here. So how will the second half of this year play out? Markets lives rerunning 22 assessment survey. Boring. Good day for risk assets so far. Yeah, so I mean, stocks are up overnight. They were up yesterday in futures markets. Obviously, were partially open yesterday. Obviously, the cash markets were closed. European equities had a decent day yesterday. They're higher again in here this morning. We'll look at that shortly. And Italian bonds are doing better in here, outperformed. So let's remember the periphery. I've been speaking about this since last week. The emergency ad hoc meeting of the ECB last week, because peripheral government bonds, particularly Italian government bonds, were selling off far more aggressively. They have been outperforming today, supported from comments from the ECB speakers throughout the European morning. So that's putting less of a strain in Europe and helping European stocks higher in here today. Okay. What else do we have? So US futures signal relief rally, Treasuries retreat. Treasury. Now, this is something I'm going to revert to now. I went through these charts yesterday. So if you look at these weekly charts, remember these are weekly charts. All the charts you're seeing here are going to be weekly charts. I'm going to zoom in a bit more, so hopefully you can see a bit better. These are, and by the way, this is out on the weekly that I put out on the weekend. Okay, the trade day weekly. You can go and see it in. I can't go to the traders page, but if you go to the members area, into the traders page in here, the trading room, if you go to the trading room under the research reports, where you get the daily technical analysis reports that I put up every day, you will also get this every weekend. This comes out, usually I put it up on a Sunday, and what this is a recap of the prior week and an outlook for the next week. Now, this hasn't been updated, obviously, it's a static report, but this was from the last 2 weeks. Big sell-off in the S&P. We had a bear gap last week, went to a new low, hit a bear market, ended up down like 23-24%. Bear market territory is obviously minus 20% from the high. Okay, European stocks look more vulnerable. What they want to show you is this divergent activity, this kind of breakdown of some of the correlations that we're seeing. So typically in here, this sell-off that we've seen generally through 2022 from European and more notably in here US stock indices has been accompanied by higher yield pressures. We've had a shoot higher in yield. So yields going up, that's bond prices going down, yields going up, okay, and that has been accompanied by the equity market sell-off. And there's no surprise in here, right? Higher yields. Now, the long-term relationship should be opposite, right? The long-term relationship from a portfolio management perspective should be when we see equities weak, bond prices go up. But at the moment, we've got this kind of opposite to what we used to call the Goldilocks effect. The Goldilocks effect used to be equities up and bonds up, right? So bonds going up because they're being kept higher by by central banks, and equities going higher because of the super low interest rates accompanying the higher bond prices, lower bond yields. Now we've got the opposite to the Goldilocks effect. I don't think we've got a name for this, but we're getting bear markets in both bonds and in stocks in here. So bonds have sold off. Remember, this is higher yields, which is bond prices going down. If we go and take a look at the bond chart in here, going back in here is the future, the 10-year note selling off. So bond prices down. Okay, what I want to show you is that dislocation. We'll see it back on that chart as well. We're over the last week in here, we're seeing a dislocation in here. So bond prices bond yields, initially went up. And then after the Fed went back down lower, and we had this candlestick in here. This is a shooting star candlestick. It's a very negative candlestick, particularly because it's on a weekly chart. Okay, so this is telling us now yields are heading down. Okay, the risk is now higher yield pressures are easing, as I've labeled on here, and the threat is potentially lower in yield, higher in bond market price. And given the correlations, that should be supportive of stocks. Should help stocks go back higher. Similarly, okay, we've had the dollar surging. Look, dollar surging through 2022. You look at how close this chart is, the dollar index chart. I can't quite get them on the same page at the same time. I can zoom out a little bit. If you look at the yield chart there at the top and the dollar chart in here, they're very, very similar charts, okay? That's because, higher yields are attractive to investors, which means then it strengthens the dollar. Also, the dollar is seen as a safe haven, as are bonds, so bonds in here in here. So we're seeing an extent to the dollar going up as a safe haven, the dollar going up because it's more attractive in here to own US assets, and it's a safe haven. So the dollar certainly going up. And so we've seen this positive correlation between higher yields. No surprise, higher yields are more attractive to an investor, more hawkish central bank. The most hawkish central bank, you would argue, on the planet is the Fed. And so higher yields in here more attractive to investors, so it helps the dollar go higher. But also in here, you see, similar to the bond chart in here, if I zoom it back in, you'll see the dollar had this pushback higher last week, went to a new high, the dollar index, and then reverted back lower. Again, that was post-Fed. It went back down lower after the Fed. And again, a failure candlestick, similar kind of shooting star type candlestick in here. Negative candlestick ended up pointing to lower dollar. And that lower dollar, why are we seeing a lower dollar, potential lower dollar, is because we don't need to own the dollar as a safe haven. So then that is implying as well more of a risk on. It's just shifting towards a risk on. Both the dollar going down here and yields going down here, very similar charts, indicating more of a risk on environment where stocks are still telling us risk off, aggressively risk off. So all these markets can be right. We can't be risk on and risk off at the same time. So the threat for me, I think, is that maybe the equity markets have got it right. And then what we're going to see is yields go even higher and we're going to see the dollar get strengthened even stronger. But for now, in the short to intermediate term, for the next week or so, the threat is the other way. And if I go back to the shorter term charts, and obviously those static weekly charts, in here, you can see there's the rebound post-Fed. Boom. And then again on, so that was, let me just get this right. This was Wednesday, Thursday, and then into Friday. And then since we've consolidated, what we're really looking for is bonds to go back higher in here. This is the September contract for the 10-year note. And if I go and flip across to here, I need to put up, let me get rid of these because these is in here. I'm going to get rid of that. Okay. And we've got the September contract in here for oh, no, that's no good. I don't want it there. I want it over here. The September contract in here for the dollar index. And what you see in the dollar index, it made a new high at the middle of last week and came back lower, okay? Did rebound then back higher on Friday, but then trying to track back lower in here. Lower dollar in here signaling more like a risk on scenario. Okay, risk on scenario. Okay, and I've also got now this is the June contract. Is this expired? Yeah, this is expired. Let me just bring this up in here, and I'm going to just put in the Australian dollar. So this is, I think, 6AU2. Okay, select that. I'll get rid of this one here. Just do some tidying up. I'll move that across to there. Okay, and what we'll see in here is the Australian dollar. You can see the Australian dollar sold off. It started to rebound from last week, right? And it did set them back in here back on Friday, but trying to rebound. The Australian dollar very much like a risk proxy, okay, a measure of risk. I'm going to take a look at the New Zealand dollar because it might give us a better idea in here. Okay, so there we go. I'm going to select that as well. And what you'll see there in the New Zealand dollar, recovering from last week up to the upside, right? Stronger New Zealand dollar. Remember, again, kind of like a risk proxy, a measure of risk, okay? The Australian New Zealand dollars, commodity currencies, commodity economies, okay? So they're trying to form a base. Again, rejecting. So this is kind of the upside down version of almost like the dollar chart, right? So we're looking for the New Zealand dollar, watching these risk currencies. If they start to move on the upside again, the Australian dollar and the New Zealand dollar, it could be significant for markets in here. We're not really seeing it with the Canadian dollar. Dollar CAD's blown to the upside, but remember, Canadian dollar is weakening. So dollar CAD has gone up. That's Canadian dollar down. And that weakness in the Canadian dollar is because we're seeing the weakness in the oil price. All right, I'm going to come back to charts. But what really the point of showing you that, guys, was this location in here that we were seeing. This location between bond and FX markets, which are telling us more, possibly shifting towards risk on, and equity markets, which are only starting to get there. Okay. Right, we've gone through there. So stocks, treasuries retreat, okay, and US futures in here pushing higher. Oil rebounds, okay, so oil has rebounded, had a significant sell-off previously. Oil rebounding in here this morning. This is a positive. Global inflation gets reprieve as wheat and oilseed tumble, okay. Agricultural commodities fell for some reprieve to rampant food inflation, right? That's going to be a positive if we can start to see food prices coming lower. We've started to see energy prices coming lower. with oil putting a topping pattern in. Okay, if we can start to see those markets stabilize, at least not carry on going up, that would certainly be seen as a positive, in that it's going to reduce the future inflation effects. Futures jump after worst week. So worst week for the S&P since March 2020. We spoke about that yesterday. European stocks have pushed higher in here. Commodity shares pushing higher. Chemicals also helping European stocks higher. Obviously, crypto is still a bit of a concern, although Bitcoin has rebounded as well. So we had a flush lower over the weekend. Bitcoin broke down through 20,000, rebounded off a support around 17.5, and has pushed back and is managing. Last I looked, it was getting back above 20,000 and holding above 20,000. Just looking at that right now. Where are we on Bitcoin? Yes, up at 20. Where are we right now? 20, just below 21,000. So Bitcoin has rebounded and holding in. Just to let everyone know, if you're not in the UK, there is a big tube strike, biggest rail strike in 30 years. It's crippled the transport system in the UK today. Further strikes expected this week. Potentially other unions outside of the rail unions going to be joining that strike or having their own strikes as we move forward over the next few weeks into the summer. This is all about inflation. This is all about pay, looking for higher pay because of and conditions also, but also around pay. Okay, and that's because obviously we've got spiraling inflation. You have inflation potentially in the UK this week with the CPI number on Wednesday. Tomorrow, going to exceed 10%, maybe as high as 11%. So where are we on the indices this morning? As I say, Europe was already up yesterday, up even higher today. We're up, depending on the index, between 0.5% and 1% in higher today on the European stock indices. And if we look on the US stock indices, we're up 1.5 through 1.75% in here. So solid recoveries in here this morning, starting to signal some basing patterns. We've been looking at this the last few days. Nothing really to add on in here. So the July meeting pretty much nailed on for a second 75 basis point hike. And then after that now, we're looking for in here for it to move. The biggest chance in here is then for a 50 at the September meeting. You can see in here, this is 125 up from where we are now. So that's 75 at the next meeting, July, and then at the following meeting, then dropping back to a 50. But there is a 40% chance of getting another 75. Okay, so there is kind of split fairly evenly between these, but really more of the chance in here of 75 and then 50. Let's take a look at some of the charts then, the actual opportunities. We've obviously looked at the Treasury chart in here at the moment. For me, this is a basing pattern. The market's consolidated at the top end of the recovery range. And just have a quick nod in here. Not many of you really trading Treasuries in here, but this looks like a bottoming pattern in here. This is a 15-minute chart. You see down here, this is either a double bottom, well, pretty much is a double bottom down here, double bottom up through here. You could argue it's some kind of inverse head and shoulders. Initially, we had the inverse head and shoulders here, right? So initially on Treasuries, so it's a solid bottom the market's got. And if Treasuries can go back higher from here, higher Treasury prices, lower Treasury yields is going to be supportive, particularly of the NASDAQ, okay? So you should be watching this if you're trading stock indices, right? You should definitely be watching this. So if I go in here, you've got this kind of neckline running across here that you had, whether you think it's a double bottom in here. But, so just to put on what we've got in here, where are we? Shapes. So we've got this kind of, you could argue it was so this is the head, and then the one on the left there I've already drawn is the shoulder, and this was the other shoulder. So initially this was like head and shoulders pattern here. Shoulder, head, there's the neckline. But then when you went down in here again, it becomes a double bottom and then up through that point there. But you broke, it was quite interesting. Look, you did go up right up to the neckline. It wouldn't go above the neckline initially, pull back. And then when it broke the neckline, impulse. Also breaking that higher then makes it a double bottom in here. So you got the double bottom in here, down here. This bigger double bottom, so bottom triggered up through that low there, double bottom, and you can see if you look at the neckline, the market's kind of respected the neckline on the way back down. Yeah, it's using that as support. Critically in here, so I think it is worth watching in here, guys. If you are trading stocks in here, this can break higher. You've got this kind of in here. This can break above this trend line here, and then start pushing back up to where we were at the end of last week, up into this area here, 116.12, 116.16 on 10 years. It needs to break above, really the overnight high here, which is 116.03. So watching out for that. A break of 116.03 is a definite positive signal for stocks. Okay, even if you're not trading, this is the thing you need to do, really, guys. This is how an accomplished trader. This is what I've worked in banks, right? I've worked in banks, mostly banks. I've got a lot of hedge fund clients. The guy's trading like wherever he's trading dollar yen. The guy's trading bonds. The bond traders and dollar yen, the FX traders, they're watching the S&P, right? Because if the levels break on the S&P, a lot of the time the S&P is the dog that wags the tail. A lot of the other markets, but not always, right? And in this case, certainly you need to be, even if you're an equity index trader, have this broader vision, this broader understanding of how markets are correlated. Because all of a sudden you might be trading the S&P or the NASDAQ, and all of a sudden it starts accelerating. I don't understand why this is moving. It's not broken in my levels, just started moving from those in. It's probably because another market, it could be the bond market, it could be the FX markets, they've triggered some levels in those markets. We're seeing the acceleration in those markets, and then it gets the correlation aspect, and it triggers the moves. Maybe in your markets, okay, in the equity indices. I would certainly be watching this, looking for a break above that little peak there. We're looking above this little counter trend line. And if it pushes higher bond prices equals lower bond yields, positive for stocks, particularly the NASDAQ, because it's a growth area. Lower yields, better for the growth stocks. If it starts to break down to the downside through the overnight low and down through this low over here, this spike low, then it all looks more of a lower price, higher yield move, and that's going to be negative for stocks. So certainly worth keeping an eye on. Saying that, let's take a look at the stocks. So we are getting this slow, gradual climb back higher. Look at this big impulsive move lower. This is the important one. We need to start to neutralize the sell-off that we saw at the end of last week, okay, which is back on Thursday. Thursday sell-off. Remember, we got the rebound on Wednesday. It looked like we were trying to put a base in after the Fed, and then the next leg crushed, okay? Now, what we need to do, we're going to zoom in and look at what we're getting back from just this down move, and then look at the bigger down move that we saw from the very end of May. So first of all, I'm going to go in here. I'm going to get rid of all the old analysis. I'm going to do this on the S&P. I know a lot of you trade the NASDAQ as well. I'm not going to go through every single parameter in here, but nevertheless, I think it's important we do it on one, and then you can replicate yourselves on the other. This is how I would look at this, right? First of all, down here, similar to the Treasury, right? It's not the same in here, but you got definitely got a double bottom. You could argue again, it's an inverse head and shoulder, right? Shoulder here, head, shoulders here, okay? And we've already completed that, whether it's a double bottom here, more like a double bottom, but you could say it's a head and shoulders because you've got this shoulder over here. And then through here, though, is definitely then confirmation, okay? And the market's broken, easily up through there. If we go and put, a stick on the horizontal line, and you can see the market doesn't even come back and have a look in here. Okay, really. Once it breaks, it has a little look and then just leaves it alone. And then if we take a look at the trend line that comes up, again, sometimes the trend line is useful off the very low, but sometimes it's a bit more useful off the secondary low. So coming off of here and then through here. In this case, it's actually coming off of the first low, I think is the real, the significant one. You could put it through here and it's reversed that trend line, but then gone back at trying to get back above it. That's not particularly a good trend line to draw it up through there, right? That's not particularly a good trend line. So I think this is the one in here. This is the one. I'm going to get rid of that. Let's just bang on that. Let's make sure it clicks to the low. Okay, it's a good trend line. It's an excellent trend line because then you do get a third touch here. And the market now sitting just above that trend line. Whilst holding above that trend line at the moment's coming in around 37.31. This looks positive. Well, not only did we then complete the double bottom or inverse head and shoulders down here through this high, you see we've also taken out these little peaks in here, this peak here and this peak in here. The next thing I'm going to look at is then since the Fed, see this really choppy price action, that's the Fed. Spike lower, significantly higher, and then that was on the Wednesday and Thursday, tumbled, consolidation, and then in effectively all of this, remember, is out of hours though. All of this is then the cash market's been closed. Okay, so we're going to have to see how the cash market reacts. But what I'm going to look at in here is now I'm going to put a Fibonacci of just a sell-off from the top of the Fed, okay, from where the Fed, so down to the low and then to the top of the Fed. And where are we in relation to that? We've got half of it back. That's since the Fed, when we got the spike higher in the Fed, it looked like it was putting a base and then rejected it and we went to a new low. We're now above, just got above this morning, and you can see in here, back there yesterday, Okay, in the partial day trading in here, we held exactly at the halfway point. This morning we've pushed above. There's the 50% halfway of the post-Fed sell-off. Okay, and we're above the halfway point. Yeah. If we can hold this trend line, I think there's real risk then up to the 61.8. Now, if you take out the 61.8 as a rule of thumb, then that neutralizes it. I'm doing, you can't see me, but I'm doing it in quotes, the rabbit ears, in quotes, that neutralizes this sell-off through the 61.8. So that's going to be an important factor to overcome. And you can see there's a little bit of a pause in there we saw. See these little peaks in here, the market accelerated, it had a little pause, and then it went lower again. So this level in here, around 37.66, okay, up through there. That's going to be my natural upside target going into the day. A breakthrough there and a hold through there is going to be certainly positive. Now, the other fib you're going to put on, okay, I'm going to just step out and put this out to a 30-minute chart, okay, is then the sell-off from the very end of May. So that's here, right? There's the sell-off from the very end of May. What we want to be doing here is getting above the 38.2, certainly above the 23.6. So that's this whole move. If I go back to the data chart, this sell-off here, since we almost put this bottom in previously in the late part of May, and then we had the capitulation back lower, is this down leg here. Okay, I'm going to put on the fib on that and see where we are in relation to that. Now, interestingly, if you go and put the trend line on there, it's not going to be, because it's so accelerated, this trend line is not going to be great. But interestingly, look, we have managed to get, that's not drawn very well. No, that's even when I'm going to get rid of that to start again. So we have gone, again, remember, this is in non-cash market trading. God, that was, what is going on with this? Let me put this around. Okay, there we go. Okay, so so this has only happened since Monday in non-cash market. Basically it's holiday trading. Okay, the market has reversed that trend line. It's not the best trend line in the world, right? The trend line is going to be the one that comes down, this accelerated one that comes down through here. And we already reversed that and then broke back lower. So in here, okay, the market in here, what I'm going to do now is then so it's reversed that trend line. Now the next thing for it to do is reverse the retracement of the whole move. So what we're going to do in here is put on this whole retracement from the very, I can't get it on there. I'm going to get rid of that. Couldn't quite click it to the top there. Okay, I can now. So I'm going to take it across over to there. So that's from that end of May sell-off. Okay, now you can see we're not even at the 23.6. This is going to be the ask. And you can see it's right near. It's important to do this, right, to get clusters of support resistance. You can see in here the 23.6 was the first retracement of the whole sell-off from the end of May. So effectively the June sell-off. The 23.6 is almost with the 61.8 of just the down leg since the Fed. Okay, so just the down leg since the 15th, the post-Fed down leg, okay, for the last week. So the 61.8 we just said was around 37.66. The 23.6 of the whole sell-off of June in here is around 37.72. Okay, so that kind of 33.66 to 33.72 area is going to be super important. It's a natural target for the market, and if we can get above there and hold, then there's real risk that a base is going in, a bigger base is going in. And again, we're going to be watching. We're getting clues. Going back to what I said much earlier on in the webinar, we're getting clues from the FX markets. We're getting clues from the Treasury markets. Well, I'm not going to do all the same analysis because I'm limited on time, guys. But you got similar in here, right? Nasdaq in here getting back quite a lot of the sell-off in here. If you go and do the same or similar analysis in here, okay, how much of this sell-off? I'll quickly do this one for you. I'm not doing all of it. Can't help myself. But in here, there you go. Right, so we're through the 50. Actually, look, Nasdaq's already through the 61.8 this morning of the sell-off, post-Fed sell-off. Okay, and if then I take this out, I'm going to take it to a 30-minute. Take it to so there's the high, the 30th of May high. I'm going to see if I can just drag that one up. And we're actually through the 23.6. So the Nasdaq has already made the statements that we're looking for the S&P to try and do. Now, Nasdaq's important, but obviously the S&P is really the benchmark. So we want that to qualify. But nevertheless, it's really, I think, significant that you've got back through the 61.8 of the post-Fed sell-off, this sell-off here, and we're already through the 23.6 of the whole sell-off since the very end of May. Actually, for the Nasdaq, the high was from the beginning of June, from the very beginning of June. Okay. All right, I'm going to do a very fast nod because of the time. I'm going to do a very fast nod to gold and oil. Starting off with gold in here, still very much defined by this consolidation rectangle. I've got no super strong view in here. Market's drifted back low. I haven't had this strong push higher. I still think there's a base in. I'm slightly positive, but the market kind of receding in here, nudging lower. From a data perspective, you'd probably want to be short, but I'm only a cautious short going into today. But if you look at my reports, I'm playing this from the long side. So no real strong view there. I've got the wrong month in here. We're now on the August contract on oil. So if I go to CL, should be CLQ. It's really the front month now, the more liquid month. Okay, I think you can still trade the July month. Yeah, it's getting very sketchy with the data. Yeah, so you want to get rid of those. So not on the July month anymore, guys. If you're trading the oil contract, you want it on the Q. Okay. Where did I just do that? There it is. So here's the daily on oil. Okay, so we are getting a rebound, but this was a really negative sell-off we saw on Friday. We'd already put a top in. It took out this low in here. It's a bigger top. Yeah, even though we've had a rebound in here, bigger picture, this is very negative. So I'm just going to go to CLQ again and add it in as a intraday. I'm going to take it into the 15-minute. So there's that capitulation last week. Yeah, we have recovered. You did put a small base in, so you got this kind of consolidation pattern went in down here. So kind of like a little triangle, little symmetrical triangle went in down here, which you would expect it to be a continuation pattern. Usually you would expect it to go here, but then it's ended up breaking to the upside. Now we do have a series of higher highs, okay? But you can see the market now, we've almost got a little double top going in here. You've got these two highs, right? If I just allow that to zoom in, you can see the market. And then also I'm just going to put the fib, first of all, of the acceleration low that we had. What did I say? It was Friday, right? You can see the market took out the 38.2 just. It's not the 50%. And now it's fading. You can see we just made a new high here. The high there was 110.75. And then here we've just pipped a new high, 110.78, but then fell. And it's flirting with this little trend line here, okay? So the question is, can it hold? Or if it breaks this low, this looks negative again, okay? So 109.17 through 109.17, this looks like a double top. And then it's vulnerable to give up this kind of breakout. And then it kind of rejects this as like a fake out breakout. Okay, so we get the breakout, and now it looks like it could revert all the way back down into here. So for me, it's still playing this one from the short side on oil. All right, and remember, August contract Q. Okay. All right, guys, I'm going to wrap it up there. It's been a long webinar. I'm going to wish you all a great trading day as ever. Take care. I'll be back with you tomorrow.